Ladies and gentlemen, what if I told you the biggest move in the gold market isn't coming from Wall Street, hedge funds, or retail investors, but from China? While much of the world has been distracted by interest rates, inflation, and stock market headlines, China has been quietly making one of the most significant strategic shifts in modern financial history. This isn't just about buying more gold. It's about preparing for a different monetary future. And if you're a gold investor, understanding what's happening now could completely change how you view the years ahead. For years, the gold market has been shaped by familiar forces. Investors watch inflation reports, central bank interest rate decisions, employment data, and currency movements, believing these are the primary drivers of gold prices. While those factors certainly matter, they often distract attention from a much deeper trend unfolding beneath the surface. Markets frequently focus on what changes week to week, while the most significant shifts develop quietly over many years. That is precisely what has been happening with one of the world's largest economies. Rather than making dramatic announcements or attempting to shock financial markets, a deliberate and patient strategy has been unfolding through steady accumulation, and its implications extend far beyond today's gold price. The remarkable aspect of this trend is not simply the amount of gold being acquired. It is the consistency behind the purchases. Large institutional buyers rarely behave like retail investors chasing momentum. They think in decades, not quarters. They recognize that meaningful positions are built gradually because acquiring too much too quickly only drives prices higher against themselves. Patience becomes an advantage. Every additional ounce secured today represents another layer of financial security for tomorrow. This kind of buying creates a fundamentally different type of demand than speculative activity. Speculators enter markets with the intention of selling at higher prices. Their holdings are temporary by design. Strategic buyers, on the other hand, often remove metal from the active marketplace for years or even generations. Once those ounces enter official reserves or long-term vaults, they become effectively unavailable to satisfy future demand. That distinction matters because supply statistics alone never tell a complete story. What truly matters is how much gold is actually available to change hands. Gold production cannot simply be turned on like a factory assembly line. Discovering new deposits requires years of exploration, permitting, financing, environmental review, and mine construction. Even after billions of dollars are invested, there is no guarantee that projected production targets will be achieved. Existing mines naturally experience declining ore grades over time, forcing producers to process more rock to recover the same amount of metal. Costs increase while production often struggles to grow. This creates an environment where supply expands slowly, even when prices encourage additional investment. Against that backdrop, persistent long-term buying begins to reshape market dynamics. Every ounce absorbed into permanent reserves is an ounce that future investors, manufacturers, and institutions cannot easily access. The impact is rarely dramatic in any single month. Instead, pressure builds gradually until available inventories become increasingly tight. Markets have a tendency to ignore these structural developments until prices begin responding in ways that appear sudden. In reality, those price movements are often the delayed consequence of years of accumulation. Another factor often overlooked is psychology. Financial markets are driven as much by perception as by mathematics. When sophisticated institutions consistently increase their exposure to a particular asset, private investors eventually begin asking why. Confidence spreads not because of headlines, but because actions speak louder than words. Large-scale accumulation sends a signal that those with extensive research capabilities see enduring value beyond short-term market fluctuations. This is especially important in the gold market because confidence itself is one of gold's defining characteristics. Unlike industrial commodities that are consumed during manufacturing, gold is accumulated primarily because it preserves purchasing power over long periods. When significant buyers continue increasing their reserves despite changing economic conditions, it reinforces the perception that gold remains a trusted monetary asset. That perception attracts additional buyers, creating a reinforcing cycle of demand. Meanwhile, retail investors often become trapped by short-term thinking. They celebrate sharp rallies and panic during corrections, assuming that every movement requires immediate action. Yet, history repeatedly demonstrates that the largest fortunes in precious metals have generally been built by recognizing major structural trends rather than reacting to daily volatility. Temporary price declines may generate frightening headlines, but they rarely alter the underlying fundamentals. If long-term accumulation continues, it is also worth recognizing that physical gold and paper representations of gold do not behave identically during periods of tightening supply. Financial contracts can expand rapidly because creating another contract requires little more than electronic bookkeeping. Physical bullion, however, must actually exist. When demand increasingly favors real metal instead of financial substitutes, availability becomes a much more important variable. Premiums can rise independently of quoted spot prices, reminding investors that physical ownership carries characteristics paper assets cannot fully replicate. Another interesting development is the increasing role of central banks in establishing a floor beneath the market. Unlike momentum traders, official institutions are generally less concerned with buying at the absolute bottom. Their objective is long-term reserve management, not perfect market timing. As a result, periods of price weakness often become opportunities for continued accumulation rather than reasons to abandon purchases. This behavior introduces a source of demand that can remain remarkably resilient even during temporary market pessimism. None of this suggests that gold prices move in a straight line. Markets never operate that way. Corrections are inevitable. Sentiment shifts constantly, and economic surprises will always create periods of uncertainty. However, beneath that daily noise lies the more important reality that structural demand has become increasingly influential. When long-term buyers consistently absorb available supply while mine production struggles to accelerate meaningfully, the balance between supply and demand gradually shifts in favor of higher valuations over time. Investors sometimes search endlessly for the single catalyst that will ignite the next major advance in gold. They wait for one policy announcement, one crisis, or one market shock. Yet lasting bull markets are rarely built upon a single event. They develop because numerous long-term forces quietly reinforce each other year after year until the broader market can no longer ignore the imbalance. Persistent accumulation is one of those forces. It does not generate excitement every week, but it steadily changes the foundation upon which future prices are determined. The lesson is surprisingly simple. Instead of becoming consumed by every daily headline or every short-term fluctuation, pay attention to what the largest and most patient participants are doing. Markets often reveal their future direction through sustained actions rather than dramatic announcements. When substantial quantities of physical gold continue moving into long-term holdings while new supply remains difficult to expand, the implications extend well beyond today's price chart. The true story is not about one month's purchases or one quarter statistics. It is about a gradual transformation in the balance of the global gold market, one that could influence valuations, investor behavior, and financial confidence for many years to come. It is easy to look at gold purchases as isolated events, measuring them by monthly totals or annual reports, but that perspective misses the broader picture. Large financial decisions made by nations are rarely about today's market conditions alone. They are pieces of a much larger puzzle designed to strengthen economic resilience over decades rather than deliver immediate results. Gold has always occupied a unique position within that framework because it stands apart from the promises and liabilities that define most modern financial assets. Unlike government bonds, bank deposits, or currencies, physical gold exists without depending on another institution's ability or willingness to honor an obligation. That quality becomes increasingly valuable whenever uncertainty surrounds the global monetary system. Throughout history, every major financial power has understood that lasting economic influence requires more than economic growth. It requires confidence. Confidence is the foundation upon which currencies circulate, trade expands, and investment flourishes. Yet confidence can shift over time as economic priorities evolve, geopolitical relationships change, and debt burdens increase. Nations preparing for the future recognize that maintaining flexibility is just as important as pursuing growth. Building strategic reserves of tangible assets is one way to preserve that flexibility regardless of how the international financial landscape develops. Gold has repeatedly demonstrated its ability to serve as financial insurance during periods of transition. It does not replace productive industries, technological innovation, or competitive exports. Instead, it strengthens the financial foundation supporting those activities. Insurance is rarely appreciated during stable times because its value becomes most apparent only when unexpected challenges emerge. The same principle applies to gold. During periods of economic calm, holding substantial reserves may appear unnecessary to some observers. During periods of financial stress, however, those reserves become symbols of stability and credibility. This helps explain why strategic accumulation is fundamentally different from speculative investment. Speculators attempt to anticipate the next price movement. Long-term planners focus on preserving purchasing power across generations. Their decisions are driven less by quarterly returns and more by structural changes that could reshape international finance over many years. That distinction is essential because it reveals that gold is being viewed not simply as a commodity, but as a monetary asset capable of strengthening financial independence. Modern economies operate within an interconnected system where currencies, trade relationships, payment networks, and capital markets influence one another continuously. This interconnectedness creates enormous opportunities, but it also introduces vulnerabilities. Heavy dependence on any single financial channel can expose economies to risks beyond their direct control. Diversification, therefore, becomes a strategic objective, not because existing systems are expected to collapse tomorrow, but because resilience requires preparation before disruptions occur. Gold fits naturally into this philosophy because it is universally recognized and globally accepted. It requires no translation across financial systems and no approval from foreign institutions. A bar of gold retains its fundamental characteristics regardless of political boundaries or monetary policies. That universality gives it a unique role among reserve assets. It provides an element of financial autonomy that few other assets can match. Another important aspect of this larger strategy involves time. Financial markets frequently reward speed. High-frequency trading measures success in milliseconds, while investors often judge performance over months or quarters. Strategic reserve management operates on an entirely different timeline. Decisions are evaluated over decades, reflecting expectations about how economic influence may evolve far into the future. From that perspective, temporary fluctuations in gold prices become relatively insignificant. A decline this quarter or a rally next year matters far less than ensuring that reserves remain strong throughout changing economic cycles. This long-term thinking also reflects an understanding that monetary systems are never static. History is filled with examples of evolving reserve currencies, shifting trade patterns, and changing centers of financial influence. None of these transitions occurred overnight. They unfolded gradually as economic realities changed and institutions adapted. Gold has consistently maintained relevance throughout these transitions because it is independent of whichever currencies happens to dominate global commerce at a given moment. One of the most overlooked characteristics of gold is that it carries no counterparty risk. Every financial contract depends on someone fulfilling an obligation. Bonds depend on issuers. Bank deposits depend on financial institutions. Currencies depend on central banks and governments maintaining confidence. Physical gold, by contrast, represents value that exists without requiring another party to perform. During stable periods, this distinction may appear subtle. During periods of financial stress, it becomes profoundly important. As global debt levels continue expanding across many economies, questions naturally arise regarding long-term fiscal sustainability. High debt does not automatically create crisis, but it does reduce flexibility. Governments facing increasing obligations often confront difficult policy choices involving taxation, borrowing, spending, and monetary policy. In such environments, reserve assets that exist outside conventional credit structures become increasingly attractive as stabilizing components of national balance sheets. Another dimension of this broader strategy involves signaling. Financial markets constantly interpret actions as indicators of future intentions. Consistent reserve accumulation communicates confidence in the enduring monetary role of gold. Such actions often influence perceptions more effectively than speeches or policy statements because they involve measurable commitments rather than theoretical discussions. Investors tend to pay closer attention to sustained behavior than to temporary rhetoric. For individual investors, there is an important lesson in observing these long-term patterns. It is tempting to focus exclusively on headlines predicting the next rally or correction, but those events often distract from deeper structural developments. Major financial transformations rarely begin with dramatic announcements. They emerge gradually as institutions adjust their balance sheets, diversify their reserves, and prepare for multiple possible futures. By the time those changes become obvious to everyone, much of the adjustment has already taken place. This perspective encourages patience. Gold has never been an asset that rewards emotional decision-making. Its greatest strength lies in preserving wealth through changing economic environments rather than delivering instant gratification. Those who understand its monetary role tend to evaluate it differently from conventional investments. Instead of asking whether today's price is a few percentage points higher or lower, they ask whether the reasons for owning it remain intact. The broader financial strategy unfolding today reflects that same philosophy. It is not centered on predicting tomorrow's headlines or next month's economic data. It is based on recognizing that resilience, flexibility, and confidence become increasingly valuable in a world characterized by uncertainty and evolving financial relationships. Gold serves as one component of that long-term foundation because it has consistently demonstrated qualities that transcend political cycles, monetary experiments, and changing economic conditions. Ultimately, the significance of sustained gold accumulation extends beyond the metal itself. It reflects a recognition that durable financial strength depends upon preparation rather than reaction. Markets may continue debating interest rates, inflation, and currency movements, but beneath those daily discussions lies a quieter transformation driven by institutions thinking in decades instead of days. Investors who appreciate that distinction gain a clearer understanding of why gold continues to occupy such an important place within the architecture of long-term financial strategy. Perhaps the most valuable lesson for gold investors has very little to do with predicting next week's price or identifying the perfect entry point. Instead, it comes from observing how the world's largest and most disciplined financial institutions approach wealth preservation. They rarely chase headlines, react emotionally to market volatility, or abandon long-term strategies because of temporary price fluctuations. Their decisions are rooted in patience, consistency, and an understanding that financial trends capable of reshaping markets usually develop over many years rather than a few trading sessions. This stands in sharp contrast to the behavior of many individual investors. Modern financial markets encourage constant activity. Every day brings new economic reports, analyst opinions, television commentary, and social media predictions insisting that immediate action is necessary. Investors are conditioned to believe they must respond to every headline or risk missing the next opportunity. Yet history repeatedly demonstrates that excessive activity often produces inferior results compared with disciplined long-term ownership of quality assets. Gold has always challenged conventional investment thinking because it is not designed to maximize short-term returns. It serves a different purpose. Its primary role is preserving purchasing power through changing economic conditions while acting as a stabilizing component within a diversified portfolio. Investors who misunderstand this purpose often become frustrated when gold temporarily underperforms stocks or other risk assets during periods of economic optimism. Those who understand its role recognize that insurance rarely appears valuable until it becomes absolutely essential. One of the clearest lessons is the importance of focusing on physical fundamentals rather than daily price movements. Prices fluctuate continuously because financial markets process countless variables simultaneously. Interest rates, currency movements, geopolitical developments, inflation expectations, and speculative positioning all influence short-term pricing. These factors create noise that can obscure more meaningful structural changes taking place beneath the surface. The balance between physical supply and long-term demand represents one of those structural forces. Mine production cannot expand rapidly, while strategic buyers often remove substantial quantities of metal from active circulation. This gradual tightening may not dominate financial headlines every week, but it steadily alters the market's underlying foundation. Investors who pay attention only to short-term charts risk overlooking the forces that eventually shape major price trends. Another important lesson involves patience. Successful long-term investors understand that meaningful wealth creation often requires enduring periods when markets appear uninspiring. Gold has experienced numerous corrections throughout its history, some lasting months and others extending for years. Yet each major cycle has reinforced the same